We have 3 stocks at or near 52-week lows. It's a great place to start looking for value. So we're going to go through these 3 companies today and see if they seem reasonably priced today. Stock number 1, Wendys. Guys, we all love Wendys. If you don't like Wendys, you are a sociopath. My personal order is the spicy chicken combo meal, but I substitute the fries for nuggets. I do the large Coke Zero light ice. Side note, the Coke Zero at Wendy's doesn't taste the best. Neither does the Coke Zero at McDonald's the first time I had it. The Diet Coke is incredible. So that's my little take on it. So Wendys, let's look at this. 5 years, guys, only a 2% increase in the last 5 years overall. 1 year is down 18%, year to date down 5%, 6 months about 5.5%. So the stock is struggling here. Now remember, if you own the company, if you own it for a long time, this sideways movement for 5 years can be very grueling on the emotions, right? I get that. And I've told you before, you buy based on fundamentals, you hold with your emotions, and that's how you make the big money. Again, you have to buy smart, okay? So look at the stock. It's even right now in terms of 5 years, basically. Let's look what it was making 5 years ago. So 5 years ago, 1.7 billion in revenue. Today, 2.18. Not much growth here, guys. Literally very little growth. So actually look back here. Going back to 2015, $1.87 billion in revenue. Not a whole lot. Good growth, great gross profit margin. What is that? Like 38% gross margin. We can find out from the financials. But let's look at the operating income here. Operating income, that's before all interest, taxes, depreciation, everything like that. I think it's before that. Yep. 247, 269, 280, 263, 285, 290, 344, 353, 391. So there is growth. The revenue's not growing, but the operating income has grown, what is that? 60% maybe? Roughly? Okay, not bad, not great. Over 1, 2, 3, 4, 5, 6, 7, 8 years. So what is that? About 5.5% a year? Okay, it's Wendys. I mean, what are they really going to grow? Their net income, about the same amount of growth. Let's look at their shares outstanding. So guys, look at this. 2016, they had 262 million shares outstanding, 244, 237, 230, 223, 209. A little bit of an increase, 213, back to 209. All right. So what does that tell me? Maybe they're taking advantage of this low stock price, potentially low stock price. Let's go back to this main page and look at some things. $260 million in free cash flow last year, 226 over the last 5 years, which is greater than their net income last year and the last 5 years. So I really like that a lot. Some people have asked me, should you make this a pillar? I'm not making it a pillar. To me, it's just an observation I'm making here. 15 times price to free cash flow, 18 times earnings. Not bad, guys. Consistent profit. Not a great return on invested capital. So they're not doing a good job of using their capital for positive gains. But look at this, 5.5% dividend yield eats up $209 million of their 226 over the last 5 years and of the 260 last year. That's a lot. That's a lot. So that's a quick recap of the company. Remember, seeing it flat should not affect you. What it should say to you is, okay, is people's perception of Wendys changing? Has it changed? 5 years to be completely flat. You've basically made your dividend. So you're looking at a few percentage points a year. Not a lot. Let's see what analysts are saying. Oh, look at this. So they're going to expect it to make $1.12 this year, $1.24, which is about 10% increase, $1.45, 17%, $1.49, $1.72. So double-digit growth per year. Okay, not bad. And then year-over-year revenue growth, low single digits. But remember, guys, they're the first ones to announce the flex pricing, which means they're going to do the Uber type of thing, which is when you go to the store, when you go to Wendy's at noon and it's super busy, you're going to pay more than if it's 11 o'clock and it's not busy at all. Call me a terrible capitalist. I love the idea. I absolutely love the idea. As a consumer, for me, if I'm in a rush and I want to get in and out and you're going to be charged more for being in line at 12, and more power to you. And if I'm in a rush and I want to pay more, I should absolutely pay more. So I love that. So let's see what the stock is worth to us today. Our famous stock analyzer tool. Bum, bum, bum. I haven't done it since June of 2022. So I'm going to have to make some altered assumptions here. Okay, first off, revenue growth. By the way, first off, their ROIC, their return on capital, is actually getting higher from 6.4 in the last 10 years. It was 6.9 in the last 5 years, 8.4 last year. Revenue growth, 2% on the low side, 4% in the middle, 6% on the high side. Okay. Profit margin and free cash flow margin. Now, I think back then it was much lower. The free cash flow was lower than the profit. So I'm actually going to switch this around a little bit. 9, 10, and 11. I have profit margin at 8, 9, 10, free cash flow margin at 9, 10, 11. Actually, you know what? I'm just going to keep them all the same because over the last 10 years, it's been still lower, but I'm fine with that. Now, PE, I put 13, 15, and 17. I still am okay with this because of that low return on invested capital. I got to get this thing cheap. But that's what makes this software so great for you. It allows you to sit there and make your own determination on what that should be. All right. Now for desired return, I put 12.5%. I'm going to change this again to 9% market return. This allows you. Now I've gotten a lot of flack and people are saying, oh, you have these high values. No, I don't. What I'm doing is putting no margin of safety in here. Of course, I want a margin of safety. You should have a margin of safety, but you need to determine what that is for you. So I'm putting the market return in here of 9%. And remember, we have to have margin of safety because as Seth Klarman says, 3 things. 1, valuation is an imprecise art. 2, we're humans, we make mistakes. And 3, the future's unknown. We have no idea what's going to happen in the future. So let me hit the analyze button. Churn and burn here. All right, I got a low price of 11, high price of 22, middle price of 15, based on, and this includes the dividend. So this return down here includes the dividend. All right. So for me to get interested, I don't know, 12, 13 bucks a share. It's still Wendys. Still 33% drop from here. You might think that's crazy, but who knows what happens. Stock number 2, a Cathie Wood favorite, Teladoc. I'm actually gonna compliment Cathie Wood here. She started buying Teladoc in 2017, sold 83% of her position at like 115 a share. She bought like 37. It went up to, look at this chart, guys. It went all the way to 308 back on February 16th, 2021. This was peak Cathie Wood arrogance level right here. Her ARK investments hit 160. We were making videos how she didn't have a good process. Everybody was blasting us. You're an idiot, Paul. You're an idiot, Paul. 47. Now, the question is, the stock is now at $14 from 308. If I told you back here that 3 years later it'd be down, what is that, 95%, what would you have said? Paul, you're crazy. I'm not saying it's obvious. What I'm saying is stocks do crazy things. It's very tough to determine stocks are going to do. Peloton is down a ton. These stocks, now I sat there and said, let's look at the financials back in 2021. 2021 financials, $2.03 billion in revenue. Okay. Operating income of a negative 238. So their basic business wasn't making any money. Negative 238 right there. And bottom line, they lost $430 million. Now, I will tell you something that's interesting to me about Teladoc before we go further. So whenever a company's not making money, I like to look at the price to sales ratio because it takes the revenue. What's the market cap based compared to revenue? That kind of tells me, hey, where are we at? Guys, look at this price to sales ratio, 0.92. That's low, especially for a company that has a 71% gross margin. This gross margin means that for every extra dollar they sell, 71% of it goes to the bottom line before overhead and taxes, depreciation, et cetera. So if they all of a sudden increase their revenue tomorrow by $1 billion, if they don't need to add any more overhead, they're going to increase their profit before taxes of 70.8%. That's an incredible number. That's $708 million. Now, with that said, other things I like. Their free cash flow last year, $194 million, net income of negative $220. So they have a higher free cash flow than net income. 5-year free cash flow, $56 billion. 5-year average net income, $3 billion loss. In the last 5 years, they have averaged a loss of $3 billion. Why? Of this. 2022, they reported a loss of $13.66 billion. Other income expenses were $13.43. So you can probably strip that out there, but they're still losing money hand over fist. Now, if you bought the stock back then, my guess is if you bought it anywhere around here, it was probably because of hype. Don't worry. We've all done that. That's why you're watching this video. My goal here is to teach the fundamentals so you can make the right purchase agreements. But even further than that, the emotional part is how you're going to make your money. Anybody can sit there and buy and learn how to buy based on fundamentals. Who can hold during the tough times? Is Teladoc a great company at 15? I don't know. We'll get into that. But the point is, we all make emotional decisions all the time. And can you remember a time you made an emotional decision besides marriage in business or investing where it worked out well for you? I can tell you every single time I made an emotional decision from investing, apart from some lucky happenstance things happening, I've regretted it every time. Every single time. If you can control your emotions, if you have the ability to see a stock that you believe in where you bought fundamentally the right way and the fundamentals are the same or better, as the stock falls, you should be able to buy more. That's how you're going to make more money. Peter Lynch has said, I bought a stock at 12, watch it go to 2, and then watch it go to 50. If the fundamentals stay the same, Mr. Market's going to throw you for a loop all the time. Now, in the short run, stocks are a voting machine, which means the emotional highs and lows of the market are going to drive stock price. But in the long run, they're a weighing machine. This company was losing money hand over fist. Hand over fist. And guys, something else I want to show you. Look at this. On the income statement, at the very bottom, it shows shares outstanding. Let's go back to 2017 when our buddy Kathy Wood bought. They had 55 million shares outstanding. They now have 165 million shares outstanding, 3 times more. So the growth in the company, any growth in the fundamentals of the business are now being split up with 3 times more investors than she had before. So let's say the company is worth 30% more based on fundamentals. Guess what? She only saw a 10% increase. That's the problem with this. And that's why I created the community, because things like this are the reasons why I created this. I use the software every single day to make my fundamental decisions. That's what everybody uses it for. All these tools, there are so many tools to use. But at the end of the day, once you've made that decision, it's all about how do you keep the emotional fortitude there to be able to go through the ups and downs and say, wait, the stock is going down, but the fundamentals are the same or better. It's hard to do that. But that's why you need that community, because if you're on your own little island, thinking and overthinking, you're going to make the wrong decisions. But if you have that support team of 1,000 investors, you will be able to make better decisions on the buy as well as the hold. And sometimes it might be like, I made a mistake, I'm out of this company. That's fine, but make it with the fundamentals in check and your emotions in check. So if you want to decrease the number of emotional decisions you're making, join the community. Click the link below, $7 for 7 days. I guarantee that you'll walk away feeling like a better investor and having better fundamental tools to make better decisions and hold in the long run. So let's see what analysts are saying about Teladoc. I'm interested to know this. Oh, wow, they're going to get to break even soon. 2027, they're going to make money. Guys, I don't even run through it. I get it. If you want to do a flyer on this one, by all means do it. Look at that revenue growth. It's not even a ton. It's mid-single digits. This is her disruption. Hey, guess what? Newsflash, telehealth is like literally the most saturated. You know how many people have pitched me telehealth deals? Now, I'm not saying Teladoc is awesome, I'm sure. I've never used it. But there's no disruption here. There's zero disruption here, in my opinion. This could become the next biggest company. 2.39 billion market cap. At one point, it was, what is that? $40-50 billion market cap? Ouch. All right. Stock number 3 took a big hit recently, Humana, one of the largest health insurers in the country. Look at this. Year to date, down 35%. 5 years, only up 17%. 10-year, up 170%. Max, 4,400%. This company's been around for a long time, folks. All-time high of 571 on November 3rd, 2022, the day before Facebook's all-time low. Isn't that ironic? Not all-time low. Sorry. $88 a share, that low since their high. Not all-time low. They went public at, I want to say $18 a share or something like that. Look at this price to sales ratio, 0.35. 0.3, that's less than a car business. PE, 15. Price of free cash flow, 13. So what does that mean? With a lower price of free cash flow, it means they report more free cash flow than net income, which is true. Now, this is an insurance company, so their numbers are a little bit different than others. I'm just going to base this on if this was a normal company with free cash flow. Whether you go look at it that way is up to you. Because remember, insurance companies, the way they operate is they take that float. They take the money that's paid in premiums. When they charge you money, they expect that that money is going to go from their pocket in full at some point in the future. But in that time period, they can invest that money for higher returns and make that spread. Warren Buffett has gotten 20% returns. There's a lot of estimates that think his returns would be 14 or 15% had it not been for float, because it's essentially a free loan for him to go out there and take cash, go invest it elsewhere, and have a free loan. So that's the key for these insurance companies. Now, dividend, 1.14%, 431 million paid. They can easily afford that. I mean, look at that free cash flow. $3 billion last year, 3.3 a year in the last 5 years. Low return on invested capital last year, but the 5-year average is 12%. Okay, not bad. Let's look at that income statement. Wow. Holy cow. 54, 54, 57, 65, 77, 83, 93, 106. Big growth, doubling in the last 8 years. Have they made any acquisitions, or was it all natural growth? No, a couple of, actually they sold off too. So on the cash flow statement, in the investing section, there's acquisitions and dispositions. A negative means cash went out, which means they bought something net. So here, disposed, basically nothing, bought something, nothing, bought something, sold, bought something. And when I say bought something, they could have bought and sold in the year, but the net is they acquired. So it seems like a lot of this growth is on their own. That's pretty awesome. Good for them. Good stuff. Let's see what the analysts are expecting. Holy cow. Jesus Christ. $30 a share this year, $49 a share in 4 years. Why did it fall so much? Let's take a look at that. It was a very simple reason. It was based on Medicare increasing their reimbursements by 3.7%, and the market wanted higher. That's a big drop for that. Now, I don't know what percentage of Humana's business is from Medicare, but that's something to know. But it's not like it went away. And we all know that the government ain't going away anytime soon. So let's look at their revenue growth. Nothing sexy. Why is this big jump over here? 25%. Geez. Okay. I like that. You know, I'm gonna ignore this 25% jump by analysts. Let's see. Let's go to the stock analyzer tool. Have I ever done Humana? Humana. I never have. We are popping our cherry right here, folks. Let's do revenue growth of 3, 5, and 7%. Profit margin, guys, these insurance companies have very low profit margin a lot of the time. Look at that. 2.5, 3, 3.5%. Let's go 3, 3.3, and 3.6. Free cash flow, I'm going to do 3.25, 3.5, and 3.75. PE, let's do 13, 15, 17. And again, I'm going to do my 9% across the board. Now remember, guys, I repeat here. It's all about you putting the numbers in here yourself. I want you to understand it, because health insurance, when it's an insurance company, not a broker, their numbers are a little bit different. So it's important to understand that aspect of the business. But I hit the analyze button, and again, this is no margin of safety in the company. Wow, all green. 368 to 400, 508 to 540, 695 to 723. If this is correct, there's a lot of opportunity here. The question is, am I looking at the right way? Guys, again, check out the link to join our community to have the conversation about Humana in the community. And if you want to see my next video on the 13 companies I currently own, please watch it. Thank you very much.